Hello and welcome to the Real Estate Investor's Guide to Retirement, investing in zero landlord management asset. Well, it's zero or near zero. First of all, we're going to give you a disclaimer. Every investment you could possibly make has a risk. Nothing is guaranteed. I cannot promise that you're going to achieve any results, nor will I or anyone else. I'm not a CPA, I'm not an attorney, and I'm not a tax advisor. I'm a real estate broker in California, specializing in commercial investment property. That is where I sit. So there's a bunch of lawyers out there who made that necessary for me to say that. I hope you all understand. What I want to talk about today, I'm going to jump right into this. I want to talk about the perfect storm that has been created by the market and several things that are happening and taking place in it. This is especially geared for those people out there, those of you who own a bunch of rental homes, apartments, duplexes, triplexes, fourplexes, that kind of thing. Like any perfect storm, and I put that in air quotes, we may not see this thing again, and this is a perfect time to learn about STNL properties, which is single tenant net lease properties. STNL properties. The market is high. What do I invest in? That's probably the most common question I get from any real estate investor that I meet or sit down with the first time. Okay, the market's high. You're saying everything's good. Where the heck do I put some money? I've got some more money to invest. I want to do a 1031 exchange. Yes, I'd love to sell this high management asset, but where am I going to put the money? And this is the question I get. Where do I put the money? So, in regard with that, the answer, and I'll give these answers, by the way. How about this? How about Burger King? Maybe there's a little northwest-based coffee shop you might have heard of called Starbucks. That's another place you can put it. You can trade John Q. Tenant that generally looks like this in a lot of locations for a Starbucks location or a Burger King location. And when I have this conversation, the first thing I see in that investor's eyes that's sitting across from me is fear, because I start talking about Starbucks or Burger King or McDonald's or net leased investments, and their eyes kind of glaze over like it's a big unknown. That's what I want to get into today. But before I do, let me talk to you a little bit about who I am. Very mercifully short on this. My name is Steve Harper. I am a real estate broker. I'm a commercial broker. I've just moved my license over, broker associate at eXp Realty. And I have brokered, purchased, sold, and consulted on commercial and multi properties since about 1999. I'm coming up on my 20th year. I have, in all of those things, probably dealt with a little over $2 billion worth of assets. I've been a radio talk show host, both on my own shows as well as a guest on other folks' real estate talk shows. And mostly over the last several years, I've been helping apartment and rental property owners learn about the single tenant net lease properties. A lot of the folks I've been working with are positioning for retirement. But as I've found as we've gone along, my team and I kind of started specializing in this a few years ago. And as we've gone along, we kind of realized there's generally one of two types of clients we end up with in this bucket of clients. And they're either the folks that are positioning for retirement, or they're recognizing this air quote perfect storm we have in the market today, and they're pulling back some of their equity and taking it out of more volatile real estate investments and placing it into more stable real estate investments based on what's happening in the market today. Now, we're going to get more into that as we go, and I'll move into that. But let's talk about today's topics. We're going to talk about an introduction to single-tenant net leased properties and commercial properties. We're going to talk about some strategy to deploy into this market so you can take advantage, again, of that air quote perfect storm. And we're going to talk about how to find single-tenant net lease property for sale and where to look for them. How to kind of look at the performing ones versus the non-performing ones. And then also at the end of this, I'm going to give those of you an opportunity that are qualified, an opportunity to have a 30-minute strategy session with us. We've got an excellent team. We like to deal with folks on a very personal level. We want to help you preserve and build wealth. That's our goal. So let's first talk about that deer in the headlights look that I get. whenever I bring this up, when someone says, "Hey, where do I put my money in this kind of a market?" and I start talking to them about the single tenant net lease properties, the glaze that I see in their eyes, it's kind of like they're predisposed that, oh, that's something that other people do. I'm not sure how to do that. It's not that complicated. All you have to learn is a few things. There's a few key points. First of all, the new terminology. You need to learn some of the red flags, things to watch out for. You need to learn and I love it because the same people will say, well, what's a good deal? I'm always looking for a good deal. And around the office, we'll joke about good deals. What you have to learn is what are the good indicators? What is telling you that this property is good, and where do I find them? And then, like anything, and I know that many of you that are on this right now may or may not have an exit strategy, but it's always good when you're going into something, you need to have an exit strategy to get out of it. And I believe you need to do that before you acquire it. This is no different. As long as you put these things in place, it's going to help you maintain some of the pitfalls that some of your counterparts will probably run into without learning some of these very basic points and strategies. So this training is not for everyone. I want to talk about who it's for and who it's not for. First of all, let's talk about who this training is not for, because there's some things I don't believe in, and I'm just going to make it very clear. If you're looking for a get-rich-quick program or some kind of a magic get-rich-quick bullet, it doesn't exist. I don't believe in it. You're talking to the wrong guy. Get off of this webinar right now, not to put too fine of a point on it. You're wasting your time. And if you're looking for get rich quick, please do not sign up for the 30-minute strategy session. Frankly, I respect you. Please respect me. Respect my time, because I don't want to deal with people that are looking for get rich quick. I'm not looking for hopeful investors that have absolutely no money or equity, but they've got an idea that they want to be real estate investors. And I don't mean to say you can't get started. You can get started, but you're not going to get started buying STNL properties with someone else's money, no money down. It's not going to happen. And again, if you're looking for that magic to make millions in real estate overnight, this is not one of those 3 o'clock in the morning talk shows. That's not what we do. We're in the real world, and it takes a little effort, but you can actually do very well protecting, maintaining, and building your wealth. Now let's get into what it is for. We're looking for those real estate investors that do want to grow their portfolio, maybe diversify, maybe posture for retirement, increase their cash flow, get rid of their management. Maybe they just want to maybe they believe that we're at a pretty top of a market right now, which I kind of think we are. And it's time for one of those cyclical changes where the market's going to go down. And I believe that we may be in that. And if we are, maybe you're just an investor that wants to go ahead and grab some of your equity, put it somewhere safer, and take it out of something that's more volatile right now. That's excellent. That we want to talk to you. If you want to learn more about that, I want to talk to you guys for the strategy for a strategy session. I'm looking for owners of real estate. You typically either need one of the two things. You either need to own some real estate, or you need to have some cash ready to place. That's really what you're looking for. So that's what we're looking for. And to keep this fair, I wanted to be honest with everyone up front. So hopefully I still kept everyone on this webinar that's qualified and should be on it. Now I want to talk to you about a couple of real world situations. There's nothing better to me when I give an example, as opposed to telling those of you that are on this they're interested. I don't want to give you an idea or a strategy. I want to show you something we really have done, something that actually happened, and was the case. I'm going to show you a couple of examples. Here's the first one. This first one is a sale that we did recently. It was a 5 property portfolio sale. It consisted of all single-family property. So there was 1 4-plex, 2 duplexes, and 2 single-family homes. And when we did our analysis of the value of this property, and we looked at what we could actually get it sold for, and we looked at what was being cash flowed, when we did our pen to paper, it should have been cash flowing a net operating income somewhere in the neighborhood of $80,000 a year. Now, I'm going to be honest with you, this absolutely wasn't. There was so much deferred maintenance and so much that had to be done every single month that really should have been buttoned up, before the family actually inherited this. But the gentleman that passed away didn't do any maintenance on it at all for over a decade. And when the family inherited it, they inherited, unfortunately, something that was, a lot of these properties were falling apart. Now, luckily, they were in the East Bay area of California. So they were, definitely a high real estate market, because we were able to actually sell these properties for $2.26 million. That is actually what we sold those 5 properties for. And just to give you an idea of how bad some of these properties look, they were all tenant occupied, so they weren't terrible. But the 2 single family homes were bought by a flipper. They were bought by a house flipper. He paid cash for them. He closed them as instantly as we wanted him to. And then we were able to position the rest of the portfolio, control the close, and then move that into a new acquisition. And what we acquired was actually $2,075,000. So there was a little bit of boot that actually this particular owner had to keep and pay a little bit of taxes on. But their income went from about $50,000 or so real world, scheduled $80,000 annual income to $131,612 with a 20-year net leased Burger King, and it was either a 10 or a 15-year net leased Doll Gen asset. They were able to buy those properties, and they significantly increased their cash flow. When they did it, they also eliminated all of their management. Literally, both of these properties were absolute triple net lease properties, which means that the tenant pays all of the taxes, real estate taxes. They pay all of the insurance. They pay all of the maintenance on the property, and they're required to do so via the leases. Literally, the work for these particular owners went from everything that you have to do with tenants and evictions and repairs and maintenance and calls. And it went to, okay, I have to check and make sure that they pay my property taxes twice a year. I got to make sure they pay their insurance premium and name me as additional insured once a year. And I have to collect the rent every time it comes in every month. That's what their work literally went to, owning this particular type of asset. Real world scenario actually happened, not kidding. Here's another one. This one was in shambles. This was a 4-plex and 2 vacant single-family homes. I believe flippers bought every one of these properties. Some of these properties were in such bad shape that they didn't even have tenants in the units. It was literally, when we looked at this little portfolio of properties, I believe it was less. 14,562 is what it came to when we did the pen to paper. I think the reality was far less than that, but let's just say it wasn't. We took them to a Taco Bell, net leased to a multi-unit operator, 80,000 net income. And it's funny, when I closed this for this lady, she actually said, Steve, I'm glad you did it, because I don't have the headache. I don't have the tenants calling me anymore. I'm not dealing with evictions. I'm not dealing with fixing things, late rent. I'm not dealing with any of those things, but I really don't believe they're actually going to pay the rent. I'm not a believer. So what I said to her is, I said, listen, Margaret, here's what I'm going to do. I'm going to call you once a month for a while and I'm going to keep calling you once a month, maybe a few days after your rent's due. And I'm going to call you just to ask you if you got paid, because you're happy that we did this, but your mind just couldn't wrap around that you're going to get the rent every single month, and they're going to take care of all the taxes, all the maintenance, and all the insurance. And when I say taxes, I only mean property taxes, but they're taking care of all of it, they being the tenant. And you know what? That one has been probably 6 or 8 months since we closed that particular property. And on that one, I actually stopped calling Margaret a couple months ago, because she finally told me, yeah, you don't have to call me every month. Every month. I actually believe the rent is going to come in every single month. And tell me, on these 2 scenarios, don't you think these landlords are happy right now? So there's a few things that you do need to learn. You need to learn, okay, what's a cap rate? Because these things are not sold the same way rental homes and apartments are. And apartments are sold based on a cap rate, kind of. But these assets are absolutely traded on a cap rate. So And the cap rate can be across the board because there's lots of different kinds of net leased investment properties, which is why you want to learn some of the stuff. You want to make sure that you learn which ones are, quote, good. So first of all, what's a cap rate? I'm going to make it very simple for you. If you put $1 million into a property and you pay cash for a $1 million property, and they told you it's a 5% cap rate. Now, I'd expect a pretty long-term, stable property for a 5 cap. But let's say that that's what they told you. What is my spendable net operating income that I'm going to get every year on that based on a 5% cap rate? Well, it's very simple. Cap rate has nothing to do with debt. So this just assumes $1 million property. You're going to get a net income of $50,000 a year. Very simple. Now, typically, when you look at one of these, there's going to be increases built in, that kind of thing. Net operating income and cap rate have nothing to do with debt. So if there was debt on this property, then we would deduct the debt from the net income, the servicing of the note, but the cap rate wouldn't change. The net operating income wouldn't change. There would just be whatever portion of this you decided for debt would come off of that net operating income. One of the most asked questions that we get in this is, do I own the business? Well, you're the landlord. The business is the tenant. So what's that look like? Well, here's one. You've all heard of Dunkin' Donuts. Well, this is a real world absolute listing of a net leased property that's available. And if you look at this, there's a few things that you can look at, and this is kind of what you'd be seeing. First thing, you got a purchase price or an asking price of $1.527 million. This thing is being offered at a 5.5% capitalization rate. That is, it was built in 2006. There's a lot of other information in here, but the net operating income is $83,985 a year. Now, if you look down on some of the writing, you'll see it's a 20-year lease. There's 2 5-year options. There's 5% rental increase every 5 years throughout the term of this lease. And this is signed by a 9-unit entity and is guaranteed personally by the franchisee that owns 9 of these things. So depending upon what that guy's net worth is, I would consider this pretty stable, as long as that net worth looks really good and that personal guarantee looks really good. Gives you a little, couple of more things that you're going to look at. It's on a major thoroughfare. It's on an interstate. But this is the bottom line, what you're going to be looking at, and the kind of thing that you're going to be looking at for a net leased property. Now, you might be sitting to yourself saying, well, I don't like Dunkin' Donuts. Well, so what? And let's look at a Starbucks. Let's look at a Burger King. Let's look at one that has nothing to do with food or retail. Let's look at a medical net lease property. There's a lot of different things that we can talk about. But this one has some cool highlights. New 20-year lease, personal guarantee. When you start seeing that and multi-franchisee owner, these are people who've learned how to make money in their business. And frankly, they're guaranteeing your income and taking all of the management off of your hands. So when we look at one of these, again, for a good example, what all are we going to be looking at on this? Well, we're going to look at a couple of things. We're going to look at the traffic counts. And if you look, based on where this Dunkin' Donuts sits, between the 2 major cross streets, it's on one that has the East 53rd Street has 29,000 cars a day on it. That is huge. That's a huge traffic count. And the cross street, Jersey Ridge Road, 9,800 cars per day. So that tells you something right there. You can also look, gosh, this is a major retail area. That hard corner by the Dunkin' Donuts, up the block there. It's surrounded. This is a vibrant business area. There's a lot of stuff in here. It even tells you what it is. There's Papa Murphy's, you got Subway, Verizon. You've got a lot of different things happening here. And then you can even look at some of the residential units in the area. You've got 288 apartments and 126 units, apartments respectively. There's some residential around there. This is a nice area to look for property. This is part of what you're going to learn to go through And you don't be taking a bunch of notes. Don't try and save this screen. I've got a gift for you. If you want it right now, there should be something popping up on your screen. I actually, my business partner and I wrote a little book. It's a real easy read. You'll get through it pretty quickly. And right on the corner of your screen here, you can click on that and you can go ahead and get signed up, and I'll send you a free copy of the Real Estate Investor's Guide to Retirement No Landlord Management Investings. And we wrote this book because of all of the questions, the same questions that we got over and over and over again as we were going through the process and kind of finding this little niche that wasn't apparent to us instantly. It literally took us probably 18 months to identify this niche based on all of the things that were happening in the marketplace right now. So investing in these markets, this is a perfect time for apartment and rental owners to diversify or transition. Now, here's what I mean by diversify or transition. Maybe you want to diversify and just have different types of assets. Maybe you want to do a permanent or a non-permanent transition. Maybe you're positioning for retirement, so your transition might be permanent. Maybe you're 36 years old and you've done very well. You've got a lot of apartments and you just want to kind of preserve some of this equity until the next downturn, and we're in that, so you can go back in and buy some of the multifamily stuff that is going to be more volatile, which is typically, I can't guarantee it, but is typically more volatile than its single tenant net leased counterpart. Maybe you just want to preserve some equity that way. And we just talked about that. Maybe you want to retire or offload some of the headache or time-intensive properties that you're dealing with. Maybe it's just the tenants that are making you nuts. Maybe you just like the idea of transitioning into STNL properties. Either way, it's for you. And either way, guess what you're going to be doing? You're going to be trading this tenant for Starbucks, for Burger King. Now, if any of you, I would just venture, you've met guys just like this. Maybe you don't rent to them. Maybe you're a really, really good screener, but they've certainly tried to rent from you at the very least. I would argue that some of them have gotten through some of your screening process, and you probably met this guy face to face. Sell 10 of these, buy one of those. Depending on the market you're in, if you're in the Bay Area of California, you might be able to sell one or two of those and buy a Starbucks. Depends on where you're located. Let's talk a little bit about this, quote, perfect storm that we're talking about. These are actual graphs. The blue line is kind of multifamily national cap rate averages, and the orange line is STNL national cap rate averages over different periods of time. And what you're going to see is, like, at this point, you can kind of see that everything is together, that everything was kind of at the same higher cap rate. And that's what happens at the bottom of markets. And you'll see how that kind of works on this graph. That's what, 2001, 2000, that's kind of where we're talking about right there. And yes, it's a higher cap rate on both, but you'll see that that the STNL throughout this time period, we got 16 years covered here, far less volatile than the multifamily. You'll also look at some other points here. Now, there's an interesting point right there. 2006, that was a pretty vibrant market that was happening and taking place. And I would argue we were getting toward the end of the vibrant market based on the line that's going to be heading up, and when those things kind of come together again right here. Again, that moved from a vibrant market. We had a down market, a vibrant market, and a down market. Now look at what's happening and where we're at right now. Now we're, 2016? Look at that spread between, some of the apartment properties that I'm actually listing and selling, I'm ashamed to represent buyers to buy them. The cap rates that they're getting for some of these apartments, at least in some of the more non-rural or the metropolitan markets throughout the country, man, they're getting low cap rates for these things, and their labor and their management intense, and they're not in great shape. Now, where are we right now? Because guess what? 2016 has come and gone. You know what? We're here. So what I'm telling you is there's an excellent opportunity to take advantage of this huge spread, to sell your your single family homes, your duplexes, triplexes, fourplexes, apartments, and either transition permanently or temporarily into STNL type properties. Historically, and I can't promise the future, but historically you can see and interpret yourself what I just showed you and what can happen. This probably came from either Real Estate Analytics or from CoStar, is typically where this kind of stuff comes from. Real Estate Capital Analytics, that's one of the commercial people that follow everything. Apartments and rentals are at some of the highest prices they've been in history. Here's what Real Capital Analytics had to say about that. In 2016, the average cap rate for multifamily reached a minuscule 4.7%. That's an average nationally, a full 50 basis points lower than the lowest cap rate seen in the last expansionary cycle of 2006 and 2007. That is a powerful statement. What can I do in this market? Again, go back to that question. The same question when the eyes glaze over when I first start talking to someone about this. Well, great. Where am I going to put my money? Well, lock in your equity by selling some of the assets that you have at the low cap rates that they are right now. Some of the lowest we have seen in history. I can tell you, historically, I don't think there's been many times in the last 50 or 100 years that we've seen cap rates as low as we're seeing them today. Avoid taxes with 1031 exchange. Absolutely, you want to utilize this. And acquire well-placed, well-researched STNL properties. And again, all STNL properties aren't the same. So let's go back and look at another one of these examples. Again, here's one available, Denny's. $1.828 million is the asking price. It's being offered at a 5.25% cap rate. You got a net operating income there, which is a net spendable pre-tax income after all property taxes, maintenance, insurance. The tenant's paying all of that. I got to remind you, the tenant's paying all property taxes, all insurance, and all maintenance on this building. Brand new 20-year lease guaranteed by a 22-unit operator, and it's got rental increases in this particular deal. It's on a major location. It's off 35 vehicles per day on Highway 27. It's near major tenants. It's in a great trade area. Now let's look at a counter to that. And I know we were looking at that, but the counter is this is an urban area of apartments in Long Beach. We got a 5-unit, so it's commercial financing. It's not residential financing. This is a real listing. 4.09%, $2,175,000 on a 1968, looks like very well maintained 1968 flat roof building, but that's exactly what it is. That is going to have issues. Yes, it's trophy, it's turnkey, that's what they're saying. And there's no rent control. They're boasting no rent control. Now, those of you that are in California on this, and probably other parts of the country too, right now, the legislature's trying to dictate statewide. They're trying to pass statewide rent control. Guess what? That bullet point will no longer stay on there based on statewide rent control when and if that ever passes. So the net operating income on this one, $88,000, $2.175 million, and a 4.09% cap rate. Now, what if you owned this particular property, but you bought that Denny's that we looked at just a minute ago? What would that look like? Well, here's what it would look like. You're going to put less money. Let's say that you were selling for $2.175 million the 5-plex and buying the 1.828. So you'd have a couple $100,000 in boot that you have to find a place to spend and pay taxes only on that portion. You're going to get rid of John Q. Tenant, 5 of them. So if you use the 80-20 rule, the very best you're going to do, depending on how you look at that, is at least 20% of those, or 1.2 of those, 1.25 of those, is going to be a bad tenant. And that's if you're not on top of it all the time. It could be worse than that. You could trade that for a 20-year net lease, 4 options to extend, 22-unit Denny's franchisee. You got a net income of, almost $8,000 more spendable every single year. You have a bunch of extra boot to spend. And the big thing is, you're not dealing with the taxes. You're not dealing with the insurance. You're not paying for those things. You're not managing the property or managing the manager. You're not dealing with the repairs, the maintenance, the garbage, the water, the sewer, all of the things that come with managing a building, because you know as well as I do. Most of you that are on this call, I believe, are absolutely qualified to be on this call. you know that you're either managing the property or you're managing the manager. One of the two things is happening. Otherwise, you probably have a really bad taste in your mouth because you're not making near the net operating income you're supposed to be. So the difference in those two, there was $347,000 in booth. We had a net income and increase by $8,000 a year. You got a 20-year lease rather than the bounce around tenants that come in one at a time, 6 months, 1 year at a time. You got rid of almost all of your owner responsibilities, and you're insulated. You insulated your equity to a less volatile real property tool. I mean, you basically went into something less volatile. So, the downside on this, I'm not seeing much. So again, I want to make sure that I'm not boasting or overstating anything. So I'm going to hit you with a disclaimer just one more time. I am not a CPA. I'm not an attorney. I'm not a financial advisor. I'm a real estate advisor. I'm a real estate broker in California, and I work throughout the country. But I am a real estate broker, consultant, and advisor. But that's my only area. I'm not a financial advisor. I'm not a CPA, and I'm not an attorney. You do have to, and with all investments, there's risk involved. You know it, I know it, everyone knows it. So there's some places that you can find it. Number one, we would love to for those of you that are qualified, we'd love to talk to you about a little strategy session based on where you're at that hopefully you get something out of regardless, and find out if maybe we can work together. But there's some places that you can start looking with or without me. You can look at LoopNet, Property Line, CoStar. These are all great websites that are out there where you can actually start looking for some property, or maybe even just familiarizing yourself with what these things look like, maybe asking prices, that kind of thing. And I totally advise you to do that. I think that's very, very good to do. A couple of things that you should know now. I mean, even without reading the book, but once you read the book, you really will know how STNL works. So again, make sure that you did click to download a copy. Hopefully, maybe he'll bring it up right now in the corner so you can click on it in case you didn't before. Go ahead and click on it now and get that book, read it, and you'll know exactly how STNL works. You'll also know in that book, and from what we talked about today, how to take advantage of the market, where to search for these types of properties. Now, again, if you would like to schedule a 30-minute strategy phone session with us, which we can talk to you about the best opportunities for you in your situation. So I'm going to take some time in that call for the first 10 or 15 minutes, gathering information from you. And then we'll discuss, have a little back and forth about some ways that you can customize a strategy to help you either grow or preserve or some of both with your wealth. And then discuss any specific questions that you may have. And if you'd like to do that, you can give us a call at 916-663-2151, and we'll schedule you for a 30-minute strategy session. Now, I want to be fair with you. I want to be direct with you. So I want to talk about who I want to use that. Again, if you're a get rich quick guy, please don't. You're not qualified if that's what you're looking for. If you currently own real estate, rentals, apartments, or even some commercial real estate, or if you have some cash on hand available to invest and you have a genuine interest in growing your wealth for you and your heirs, then I want to hear from you, and I want to go ahead and schedule that 30-minute strategy session. If you've been watching late night TV, you're late on your rent right now, you don't own anything, you have no cash to invest, and you've heard that you can use other people's money to get rich, please don't waste my time or yours. I can't help you. I don't believe in get-rich-quick schemes. I believe in growing your wealth and doing it very wisely when it comes to real estate, whether it be residential or commercial. Again, give us a call if you'd like to schedule with us at 916-663-2151. I look forward to talking to you soon, and thank you very much for your time today.